Wall Street, a name that resonates with power, ambition, and the relentless pursuit of wealth. Just the name conjures images of wealth, power, and ambition. It is a place where dreams are made and shattered, where the pulse of the American economy beats the strongest. It is where fortunes are made and lost, where the American dream is both pursued and shattered. The trading floor of the New York Stock Exchange is a theater of human emotion, a place where the stakes are high and the outcomes uncertain. From its humble beginnings as a Dutch trading post to its current status as a global financial hub, Wall Street has been a driving force in the American economy. Its history is a tapestry woven with threads of ambition, innovation, and sometimes greed. But it has also been a source of controversy, blamed by many for exacerbating inequality and triggering economic crises. Movements like Occupy Wall Street have highlighted the growing discontent with the financial elite and their perceived role in widening the gap between the rich and the poor. This narrow street in Lower Manhattan, home to the New York Stock Exchange and countless other financial institutions, has become synonymous with the American financial system itself. It is a place where decisions made can ripple across the globe, affecting economies and lives far beyond its borders. Its influence extends far beyond the skyscrapers that line its streets, shaping the lives of everyday Americans and influencing global markets. The decisions made here can determine the fate of industries, the value of currencies, and the economic well-being of nations. But with great power comes great responsibility, a lesson that Wall Street has learned time and again throughout its tumultuous history. The financial crises that have erupted from this small stretch of land have had far-reaching consequences, teaching hard lessons about risk, regulation, and the human cost of financial mismanagement. From the Gilded Age to the Great Depression, Wall Street has been at the center of America's economic highs and lows. The opulence of the Gilded Age gave way to the stark realities of the Great Depression, a time when breadlines and unemployment were stark reminders of the fragility of prosperity. From the dot-com bubble to the subprime mortgage crisis, the cycles of boom and bust have continued. The exuberance of the 1990s tech boom was followed by the devastating crash of 2008, a crisis that shook the global economy and led to widespread calls for reform. Wall Street has ridden waves of boom and bust, leaving both prosperity and devastation in its wake. The symbols of the bull and bear markets are more than just financial jargon. They represent the hopes and fears of investors, the cycles of growth and recession that define the economic landscape. This essay delves into the complex history of Wall Street, exploring its evolution, its impact on society, and the ongoing debate about its role in the 21st century. As we navigate the challenges of a globalized economy, understanding the lessons of Wall Street's past is more important than ever. We will examine the key events that have shaped its trajectory, the figures who have left their mark, and the policies that have attempted to regulate its immense power. Join us as we unravel the story of Wall Street, a story that is still being written today. The turn of the 20th century marked a period of rapid industrialization and economic expansion in the United States. This era, often referred to as the Gilded Age, saw the rise of powerful industrialists and financiers who would leave an indelible mark on the nation's economic landscape. Wall Street became the epicenter of this boom, attracting ambitious entrepreneurs and financiers who sought to capitalize on the nation's burgeoning industries. The stock exchange was a hive of activity, with brokers and traders working tirelessly to buy and sell shares in the companies that were driving America's growth. One such figure was J.P. Morgan, a towering figure in American finance. Morgan was not just a banker, he was a visionary who saw the potential for creating vast industrial empires through strategic mergers and acquisitions. Known for his shrewd business acumen and ruthless negotiating skills, Morgan orchestrated mergers and acquisitions that created industrial giants like General Electric and U.S. Steel. His influence extended far beyond the financial sector, as he played a crucial role in stabilizing the American economy during times of crisis. Another titan of the era was John D. Rockefeller, founder of Standard Oil. Rockefeller's approach to business was methodical and relentless, focusing on efficiency and control to dominate the oil industry. Rockefeller's relentless pursuit of efficiency and control over the oil industry made him one of the wealthiest men in history, and his influence extended to Wall Street, where he financed railroads, banks, and other ventures. His business practices, though often criticized for their ruthlessness, set new standards for corporate management and efficiency. These early titans of Wall Street helped to shape the landscape of American capitalism. Their actions and decisions had far-reaching consequences, influencing not only the economy but also the social and political fabric of the nation. Their ambition and ruthlessness fueled unprecedented economic growth, but also laid the groundwork for the concentration of wealth and power in the hands of a select few. This concentration of wealth created significant disparities in income and living standards, which would become a source of tension and conflict in the years to come. This concentration of wealth and the unchecked speculation on Wall Street would ultimately contribute to the financial instability that led to the Great Depression. The crash of 1929 was a stark reminder of the dangers of an unregulated financial system, and it prompted significant changes in how the American economy was managed and regulated in the decades that followed. In response to the Great Depression, the federal government implemented a series of reforms known as the New Deal, aimed at stabilizing the economy and providing relief to those affected by the economic downturn. These reforms included the establishment of regulatory bodies to oversee the financial markets and prevent the kind of speculative excesses that had led to the crash. Today, the legacy of these early titans of Wall Street can still be seen in the modern financial landscape. While their methods and practices have evolved, the drive for innovation and the pursuit of economic growth remain central to the ethos of Wall Street. The lessons learned from their successes and failures continue to shape the policies and practices that govern the financial markets today. As we look back on the early 20th century, we can see how the ambitions of a few individuals helped to shape the course of American history. Their legacies, both positive and negative, serve as a reminder of the power and influence that can be wielded by those who control the engines of economic growth. The Roaring Twenties were a time of economic prosperity, a period marked by rapid industrial growth, technological advancements, and a booming stock market. Social change was also in the air, with the rise of jazz music, flapper culture, and a general sense of liberation and modernity sweeping across America. Wall Street boomed as stock prices soared to unprecedented heights, driven by speculative investments and a widespread belief that the market could only go up. However, this era of exuberance came to a crashing halt on October 29, 1929, a day that would forever be known as Black Tuesday. The stock market plummeted, wiping out billions of dollars in wealth in a matter of hours. The stock market crash of 1929 marked the beginning of the Great Depression, the worst economic downturn in modern history. The impact was immediate and devastating. Millions of Americans lost their jobs, their homes, and their life savings. Bread lines and soup kitchens became common sights as people struggled to survive. The crash exposed the dangers of unchecked speculation, where investors borrowed heavily to buy stocks, creating a bubble that was bound to burst. It also highlighted the fragility of the financial system, as banks failed and credit dried up, leading to a cascade of economic failures. It also revealed the interconnectedness of Wall Street and Main Street, as the collapse of financial markets reverberated throughout the broader economy, affecting businesses and individuals alike. Factories shut down, unemployment soared, and the American dream seemed to slip away for many. The ripple effects were felt worldwide, leading to a global economic crisis. The Great Depression had a profound impact on Wall Street, leading to stricter regulations and increased government oversight of the financial industry. The era of laissez-faire capitalism was over. The Securities and Exchange Commission, SEC, was established in 1934 to protect investors and regulate the stock market, ensuring transparency and fairness in financial practices. Meanwhile, the Glass-Steagall Act separated commercial banking from investment banking, aiming to prevent risky speculation with depositors' money. These reforms were designed to restore confidence in the financial system and prevent future crises. The New Deal, introduced by President Franklin D. Roosevelt, brought about a series of programs and reforms aimed at reviving the economy and providing relief to those affected by the Depression. Public works projects created jobs, while social safety nets were established to support the vulnerable. Slowly but surely, America began to recover. The lessons learned from the crash and the Great Depression reshaped the financial landscape, leading to a more regulated and resilient economy. Today, the legacy of the crash and its aftermath serves as a reminder of the importance of financial oversight, and the need to balance economic growth with stability. The resilience of the American spirit and the strength of its institutions have ensured that the nation continues to thrive even in the face of adversity. In the decades following the Great Depression, Wall Street's influence on American politics grew steadily. The financial industry became a major source of campaign contributions, lobbying efforts, and revolving door appointments, whereby government officials moved back and forth between public service and lucrative positions on Wall Street. This close relationship between Wall Street and Washington raised concerns about conflicts of interest and the undue influence of special interests on government policy. Critics argued that deregulation, driven by Wall Street lobbying, contributed to the financial crisis of 2008. The revolving door between Wall Street and Washington became a symbol of this cozy relationship. Former Goldman Sachs CEO Henry Paulson's tenure as Treasury Secretary during the 2008 crisis fueled accusations that Wall Street was calling the shots in Washington. This intermingling of Wall Street and Washington has fueled public distrust in both institutions. Many Americans perceive a system rigged in favor of the wealthy and powerful, where Wall Street's interests often trump those of ordinary citizens.